To start a business, you need money, right? That's why we will be talking about crowdfunding as one source of capital for your company today. This video is also part of the Business Basics series, where we explain essential terms and key concepts to you, which are necessary for entrepreneurs, why actually everybody should know them. So stay tuned, guys. Whether you want to start your Amazon FBA, sell online courses, or open up your own cafe, you always have to make essential investments in the beginning to start everything up. And you can either finance them by yourself, if you have enough capital necessary by your own, or you need to have other people giving you money to do your business, right? One method you can apply here is crowdfunding, where the basic idea is to leverage the power of many people. And you have one rule, which is the more investors you can attract, the lower the individual investments can be, while in the end you would still have a huge amount of money to start your business with. There are different ways you can realize a crowdfunding campaign, and we have prepared the main ones for you, including examples, with the first one being the pre-sale method. This is actually the simplest form, and as the name implies, a person that is investing in a company buys a product which is not developed yet. And if enough people buy the product, it can be developed and finally delivered to the investors, who turn into customers at this point. A partial pre-sale is possible as well, with the customer only paying part of the product in advance and the rest after it has been developed. By the way, not only startups use this method, but for example, Porsche, when they released their new Taycan model, had a waiting list where you could pay, I think, $10,000 in advance, and this would give you the opportunity to buy a full model after that. So this is not only for small scale businesses, but also for big concerns like Porsche. One pretty good example for pre-sale crowdfunding is the platform Kickstarter, where companies can place their undeveloped products and search for investors. In the beginning, the prices are most often lower, because you would get a discount for taking higher risk in the beginning, and with the time when more investors come, the prices increase and line up with the market price of the product. Upsides of the pre-sale method are at first that it guarantees a number of sold products before even having to develop one and spending money on it, right? Which reduces risks for entrepreneurs because one doesn't have to go too far into debt before even having sales. And secondly, it can function as a market test to prove the demand for the product. So if you have a high number of pre-sales, you know that when the product is developed, probably a lot of people will buy the product, and it makes sense to continue with your startup. So far, pre-selling sounds pretty great for a startup, but now we'll have a look at the disadvantages. So pre-selling puts high pressure in the development of a product, as a lot of expectations have been created at the beginning. These shouldn't be disappointed, as this could lead to bad publicity or even legal issues. Secondly, in the pre-sale method, there's often a delivery date, and this increases the pressure even further because you can't always plan how the development of your product will go forward, right? And the already fixed price might also develop into weakness of the strategy, as you can't always plan the real cost of development for the product. So errors in calculations are likely, and it is possible that you make a loss selling your products to the investors. And finally, the model of pre-selling might not appeal to all investors, as they might not be interested in product itself, but in profiting from the growth of the products. However, all in all, a well-calculated pre-sale is a pretty great opportunity for a company to finance the development of a product, especially for smaller firms and individuals who don't have access to big venture capital firms. However, its strength can always turn into weakness, so always take care and calculate your risks. We will now have a look at another strategy, which is called equity crowdfunding. In this case, an investor is not going to receive a product of some sort, but rather buys a share of the company in order to profit off its business. In the most common form, equity crowdfunding puts more legal restrictions on the founder himself. He or she is not only required to produce the product, but also create the company in order to provide the equity. There are several pros for equity crowdfunding. At first, equity crowdfunding allows a firm the access to investors which aren't actually interested in the product itself. So this is a huge upside comparing equity crowdfunding to pre-selling. And apart from addressing more potential investors, this allows more flexibility in the development of the product as investors aren't really interested on a specific feature of the product, but rather convinced of the idea of the company itself. Finally, as pre-sale, equity crowdfunding increases the resources of a firm and simultaneously spreads the risk and takes it away from the entrepreneur. Downsides of equity crowdfunding are pretty clear. Compared to pre-sale, it doesn't show the demand of the product, so investors often do not represent a target group and thereby misdirect the view of the startup. So you don't have the market testing component where you know the demand of the product, and this actually increases your risk in a startup. Finally, with equity crowdfunding, the founder of a startup hands over power to investors, which can have positive or negative effects, but overall increases the risk for the founder himself. The last implementation model of crowdfunding is called debt-based or also peer-to-peer, where a group of individuals lend money to a company to support its activities. They eventually get the money back, including some interest rates. As a compensation for the high risk, these loans most often have a higher interest rate as a bank, which can range between 5 or 10%, which is, pretty high. One platform which is used in peer-to-peer crowdfunding is, for example, Lending Club, which launched in 2014. Our last model we will introduce you with is donation-based crowdfunding, which is mostly being used for pro-social and pro-environmental projects. Here, individuals donate for altruistic reasons mainly, and that's why this form of crowdfunding is often suited for commercial projects and companies. Most often, NGOs finance themselves using this peer-to-peer crowdfunding method. One example for that could be the Ocean Cleanup Project, which aims at removing plastics from the ocean in order to protect the environment. Alright guys, that's it. I hope you've liked the video. I hope you've learned something. If so, please leave a like and a comment, and please tell us which topics you're interested in so we can make more videos about them.